in this session, we are going to look at the events after the reporting period. Now, this section is included within IAS 10, which defines events after the reporting period as those events that are favorable or unfavorable. So it's not just the things that are going the way of the entity itself. It could be good things or it could be bad things that occur between the end of the reporting period and the date when the annual financial statements are authorized for issue. Okay, so once these annual financial statements are authorized for issue, that's when we stop looking at events after the reporting period. But they must occur between the end of the reporting period and the date when the financials are in fact authorized for issue. So do we adjust for events that occur after year end? Well, sometimes. It's going to depend on the information that those events in fact give us, and that's going to determine are they adjusting or non-adjusting. Okay, so if they give us information of events that took place prior to year end, yes, then we should adjust. If it gives us information of events that did take place after year end, then we will not adjust. So some adjusting events, what should you be asking yourself if it is in fact going to be adjusting? So if the event gives you more information about something or a condition that existed at year end or before year end, if yes, it does give you information about something that either existed or a matter that took place before your end, yes, then you must adjust the annual financial statements for that additional information. The condition must have been in existence at your end. So for it to be adjusting, it must have in fact existed or taken place during that financial year. Otherwise, it would not be deemed to be adjusting. And as we said, it can be a good thing or a bad thing, either favorable or unfavorable for the business itself. And so what are non-adjusting events? So these are indicative of conditions that arose after the reporting period. Okay, so this means that the event actually did take place after the financial year end. And that then means if it's not something that took place during the financial year in terms of those set of financial statements, then you will not adjust for it. Okay, so it won't be adjusted, but you might find that disclosure could be appropriate. Okay, so if disclosure is going to be important, so if the event is in fact material and non-disclosure would affect the user's understanding of the financial statements, then it would be deemed relevant and it should in fact be disclosed. Okay. But it doesn't mean that you're adjusting the financials, you're just providing information about this event for the benefit of the users of the financial statements. We're now going to look at example 18 from your Gripping Gap textbook. This example says to us that a debtor who owed Nuyo Limited 100,000 Rand at the 31st of December 2022 had their factory destroyed in a fire, and as a result they filed for insolvency. The following information is relevant. A letter from the debtor's lawyers was received in February 2023, so this letter was received after year end, in which it was stated that they will probably pay 30% of the balance that is owing. The financial statements are not yet authorized for issue, so this is an event after the reporting period, and we can decide whether it's going to be adjusting or non-adjusting. We're told that the fire that caused him to file for insolvency occurred during December 2022. So here we can already see that the event did take place during our financial year end, and that then triggered his insolvency, which means that that amount of 100,000 Rand that he owed us was not going to be collectible. We're required to explain whether or not the above should be adjusted for in the annual financial statements as at 31st of December 2022. If adjusting, you need to provide for the journal entry. Okay, so we said, is this a post-balance sheet or an event after the reporting period event, yes, we receive a letter from the lawyers after the reporting period in February 20X3. Now, what did that give us information about? It gave us information about a debtor who became insolvent due to a fire that destroyed their factory. When did that fire actually occur? It occurred before year end. So therefore, it must be an adjusting event. Okay, so the event that caused the insolvency was the fire. The fire happened before year end. Therefore, it is an adjusting event, and we must account for that 70,000 Rand that we expect to not receive from this debtor. So we debit our impairment loss, profit or loss, 70,000 Rand, and credit our allowance for credit losses of 70,000 Rand to show that we are providing for that 70,000 Rand that we don't expect to receive from this debtor. Looking at example 19, it tells us that a debtor who owed New Year Limited 100,000 Rand at 31st, oh, this is the same. Okay, so that's just the repeat. Okay, looking at dividends. If dividends is declared in the post-reporting period, they must not be adjusted for. So that's the rule. For dividends to be declared, they must be declared prior to year end for it to be relevant. Okay, no present obligation exists as the obligating event or the declaration does not occur before year end. Okay, so if it's declared after year end, we're not going to adjust. If it is declared before year end, we must adjust for that. So dividends declared in this case where it is after the reporting period must simply be disclosed in the notes, and that would be an example of a non-adjusting event. Okay, so dividends declared after reporting period is non-adjusting. Dividends declared before reporting period is adjusting. We're now going to look at a number of different scenarios with example 20 from your Grip and Garp textbook. This example has a number of different scenarios, so we're able to really apply ourselves and the information from our events after the reporting period. This example says to us that Finito Limited is currently in the process of finalizing their financial statements for the year ended 31st December 20X2. The following events occurred or information became available between the 1st of January 20X3 and 28th of February 20X3. The date the financial statements were in fact authorized for issue. Okay, so this information tells us that these events did take place in that post-balance sheet period. So we need to decide, are these events in fact adjusting or non-adjusting? So the first scenario where it's told about is that scenario A debtor is owed Finito 110,000 Rand at year end, and they were in financial difficulties. An impairment loss adjustment of 30,000 Rand was processed, and the debtors' lawyers announced they would be paying 40% of all the debts. Okay, so now that the lawyers have announced that they would be paying 40% of their debts, we now know that the impairment loss adjustment that we processed of 30,000 Rand actually wasn't adequate. So this is in fact an adjusting event. It tells us about the balance that they owed us at year end. We clearly did know that they had financial difficulties and that we wouldn't be able to recover that 110,000 Rand, which was evidenced by the fact that we processed an impairment loss adjustment of 30,000 Rand. Now we know that that 30,000 Rand that we processed was actually not enough, and we can provide for now a more accurate estimate. So it's an adjusting event, 110,000 times by 60%, which is what they won't be paying, less the 30,000 Rand that we already basically wrote off as an impairment loss, means we need to process an additional 36,000 Rand by debiting the impairment loss, profit and loss, and credit the allowance for credit losses with 36,000 Rand. Scenario B tells us that debtor owed 150,000 Rand at year end, and they had their factory destroyed in a labor strike during 20X2. So as we can see, that labor strike that caused the insolvency, because they filed for insolvency, took place during the financial year. So that then means it must be an adjusting event. They're probably going to pay 60% of their balance. Okay, so that was an adjusting event because the actual strike took place during our financial year, which led to the insolvency. So that then means the 150,000 Rand times 40% means we must account for an allowance for credit losses of 60,000 Rand. So debit impairment loss, profit or loss of 60,000 and credit the allowance for credit losses at 60,000 Rand. Scenario C, we're looking at inventory that was carried at 100,000 Rand, which was sold for 80,000 Rand in January 20X3. It was in fact damaged in a flood during June 20X2. Okay, so as we can see, this inventory must always be recorded at the lower of cost and net realizable value. So it was sitting at an amount of 100,000 Rand, but the fact that we sold it for 80,000 Rand clearly shows that it was worth lower than what we were carrying it at in our books. We then are told that the reason it was worth lower than what it was carried at in our books was due to a flood that took place during the financial year. And because that flood took place during the financial year, which caused the decrease in value of inventory, it is in fact an adjusting event. And we must write down that inventory from the 100,000 Rand to the 80,000 Rand. How do we provide for a write down? We debit our cost of sales with 20,000 Rand and we credit inventory with 20,000 Rand. So we bring our inventory down from the value it was carried at of 100,000 Rand, and we've written it down by 20,000. So it's now reflected at the correct value of 80,000 Rand. Scenario D is where current tax of 30,000 Rand was incorrectly debited to revenue on 20X2. Okay, so if revenue was incorrectly debited, we're going to have to credit it to basically correct that incorrect journal entry. So to fix that mistake, we need to credit revenue with 30,000 and we debit our income tax of 30,000. So now that one is correctly debited our current tax of 30,000 Rand. This in fact is an adjusting event because it does relate to our 20X2 financial year. And so we're simply correcting an error in this scenario. Again, you'll see that coming through as we do IS 8. Scenario E, Finito decided on the 28th of December 20X2 to close down a branch. The announcement would be made on the 15th of Jan 20X3. Okay, so here we can see at year end, they've decided already to close down the branch, but was there any obligation that was created before year end? Okay, certainly not. The constructive obligation is only going to take place after year end on the 15th of January 20X3. Okay, so this would be a non-adjusting event because the expectation was not created before year end. It's only going to be told after year end. And so we don't have any constructive obligation. Okay, so in this scenario, like we said, it's a non-adjusting event, but it's probably going to be something very material. You might want to still disclose the fact in your annual financial statements that they will be closing down a branch. Okay, because of course, those annual financial statements, by the time they're authorized for issue, it will certainly be after the 15th of Jan 20X3. Okay, so you could disclose that information in your financial statements. Scenario F, there's a court case in progress at 31st of December 20X2. The court case entails radiation that occurred from cell phones that were purchased by customers during the financial year of 20X2. No provision was, however, made. On the 20th of February 20X3, Finito lost the case, the court case, and the amount estimated at 200,000 Rand to, in fact, settle that court case. No inventory causing radiation was on hand at year end. And so if we look at year end, the court case was in progress where radiation was allegedly taking place. So at that point, you might want to consider a contingent liability where you disclose the information around the court case itself. Because at that point, it would be considered more likely that no obligation existed at year end. We don't have any definitive answer where we could raise a provision at that point. Then the possible legal obligation relating to sales made before year end. So You would need to consider that as part of your discussion to try and decide, do you in fact have something that you must account for? So when looking at this, we would say we do have an adjusting event, because based on the court decision, that court case that was in progress at year end confirmed the fact that there was radiation experience from the cell phones purchased by customers. And so because they ruled against Finito, there is in fact a legal obligation and a liability would then be recognized. But there's no set amount. We don't have a physical 202,000 Rand and 50 cents. Okay, so we don't have an exact amount, but we do have an estimate. So because it's an estimate, we can't raise a pure liability, but we can raise a provision because we've got a reliable estimate of 200,000 Rand. Debit our legal cost of 200,000 Rand, credit our provision for legal costs of 200,000 Rand. Scenario G is where a customer lodged a claim in February 20X3 for food poisoning experienced in January 20X3. All the cans produced in December 20X2 were poisoned. So as we can see, they lodged a claim after year end, and the food poisoning also took place after year end. But the cans were produced before year end. The claim is for 100,000 Rand. The carrying amount of the cans is 80,000 Rand, and lawyers estimated damages to cost 1 million Rand, but there was no reliable estimate that was available. Okay, so there's a couple of different pockets of information here that we need to consider. So firstly, looking at the inventory itself. And we know that all the cans were produced in 20X2 were poisoned. Okay, so that immediately means that the inventory we did have before year end was tainted, okay, it was poisoned, and that's telling us that inventory we had at year end we would need to write off. So that part is an adjusting event. We'd do the write-off by debiting cost of sales with 80,000 Rand, the full carrying amount, and credit inventory with 80,000 Rand. So all those cans produced before year end, they were poisoned, they needed to be written off. Then looking at the claim, remember this claim took place after year end, and the food poisoning actually also occurred after year end. So this would in fact be a non-adjusting event. Then when we look at future claims, because there may be other customers who have also got these cans that are poisoned, so there is potential that additional customers may come forward. That would be a contingent liability. Why are we saying this is a contingent liability? Because the estimate of 1 million Rand is not reliable. So it means we can't raise a provision. We then go to the next lower level, and that would be a contingent liability because there is uncertainty in terms of that estimate. We are unable to obtain a reliable estimate. Also, it is a possible obligation. We don't know how many customers are going to come forward claiming that they have been poisoned. Scenario H, Finito declared a dividend on the 20th of February 20X3 of 30,000 Rand. So yeah, they declared a dividend after year end. So if it's after year end, that means it's non-adjusting event. There's no obligation, but you can disclose it in your financials. Now, there is, however, one exception to events that are adjusting and non-adjusting, and that's in terms of the going concern ability. So at the end of each financial year, you will assess the going concern ability of the company. That means, will this company continue to operate for the foreseeable future or for at least the next 12 months operating period? So if the going concern assumption is not considered valid, even after the reporting period, then your financial statements have to be revised whether or not it existed at year end. Okay, so this is the only exception to the rule, that even if perhaps you lose a significant contract after year end and your company is actually going to end up closing, you would need to adjust for that. So that's the only exception. There are only two bases really of preparation. You either prepare on the going concern basis, which is generally what we do for financial statements, or the alternative, if the business is not going to operate for the foreseeable future or the next 12 months at the very least, you would use the liquidation basis of preparation to prepare the financial statements. And looking at some of our disclosure requirements for adjusting events, they're adjusted when preparing the financial statements. And as we've seen with adjusting events, how do we adjust for them? We provide a relevant journal entry. Our non-adjusting events, no journal entry, but we do disclose information such as the nature of the event, so what actually took place. Like in one of our previous examples, we can say, well, we produced cans that were poisoned. What is the estimated financial effect? Like with that example, we can say the estimated effect is approximately R1 million that we would have to pay out in damages. And if not, state the financial effect cannot be determined with reasonable certainty. Okay, so even if you can't give an actual value, you must state that you can't give a value with reasonable certainty.